Well, capital flight, both within Europe and out of Europe, is now accelerating and will soon turn a potential crisis into a real crash if action is not taken soon. Time is running out, not just for Europe, but the world. Now, Greece was and still is a problem, but Spain is another matter entirely. I've been reading comments for more than a year now that it's too big to fail and too big to bail. But that's now no longer just a theory. Here's a chart of its bond yield versus German bunds. It's now back to the GFC peak, even as Germany's yield approaches zero. And for two-year bunds, it actually is zero. Now, the problem has been endlessly analysed and the solutions are well known. Europe is in depression because banks and governments are deleveraging at the same time. Now, banks must be recapitalised or nationalised to a point that stops the run on deposits. The European Central Bank can and should supply more liquidity to them, but that would be useless if they're insolvent. Austerity must be eased and pro-growth policies applied. Eurobonds need to be created so that cross-guarantees can apply to the insolvent sovereign borrowers, mainly from Germany. The IMF and China need to supply more bailout funds. And finally, Europe must move towards fiscal union, with meaningful rules and much stronger institutions. In short, it has to become more of a federation. Now, everyone knows all that, but the political reality is that it can't or won't be done, mainly because of German intransigence. No one knows what the consequences of failure would be, but here's a chart that might act as a warning. It plots the Euro Stoxx 50 share index since 1990 against the Japanese Nikkei index from 1979. Now, Japan didn't deal with its problems either. At this point, it was 12 years into a 22-year depression that's still going. Now, that will be Europe's fate as well, only this time its fate would be shared with the rest of the world. And joining me on the couch this week, Tom Elliott, Chief Investment Officer at Beulah Capital, the Companies and Markets Editor at the Australian Financial Review, Nabila Ahmed, and Roger Montgomery, founder of Montgomery Investment Management. Welcome, everyone.
Thank you.
Morning, Al.
Nice to be
Roger,
here.
tough time to be a value investor, I guess. I mean, you can find a company that looks good value and then the thing gets blown up because of what's happening in Europe.
Yeah, look, the reality is there's two ways to approach this. You can watch everything that's emanating from Europe and try and analyse what the reaction of the market is going to be, and that's a really tough job. Or you can ignore it and simply look for good value and very large margins of safety, which haven't occurred. We haven't seen that. We've seen a sell-off in stocks. But there aren't that many really high-quality businesses that are cheap enough to take our interest. We're still 65% cash, and we're outperforming as a result of that high cash weighting. My big concern for Europe is that we're delaying the inevitable, and we'll end up in this perpetual cycle where every time a bank gets propped up or every time a country is bailed out, we get a rally in stocks, and when there's fear that that won't be sustained, then we get a pullback again, and we end up in a very long period where we get quite low nominal returns out of stocks because, in aggregate, because of this type of volatility that's emanating ultimately from Europe. The best thing that we could actually do is actually allow some of these countries to fail, allow them to default. It's a painful thing for the countries involved, obviously, but the reality is that countries ultimately recover. They attract more investment capital when outside investors can buy their assets more cheaply.
What do you reckon, Tom? Default? Let them go?
Well, look, part of me agrees with Roger. I mean, countries like Japan, we saw on the graphs there, didn't deal with their problems, and problems just have a habit of continuing. But, gee, I mean, a full-on default could mean the end of the whole Euro dream, the United States of Europe. I think actually Europe has got to do what you suggested, Alan, and bite the bullet and say, you know what, all you broke governments out there, guess what, you're not allowed to be governments anymore. You've got to. The problem is, of course, it'll be the Germans at the top, and those with long memories perhaps don't want to see that happen. So it's a difficult situation.
Yeah, I'd argue that I think that's right. It is going to be really tough if you didn't do it.
You were saying before that it's like 9 mates stand around and they're all broke except for one of them, which has got money.
Which is Germany.
Which is Germany.
Arguably. And arguably Germany doesn't have the money either. But yeah, the argument is that they're all getting together and saying, well, look, let's guarantee each other's debts. And there's one country that can afford actually to pay and they don't want to be the one that covers everybody else's debts. You sort of drag it down to the weakest link. But the problem can be solved quite simply, I think. In the long run, it'll be solved by actually allowing these countries to default. and allowing them to start again and start rebuilding their countries.
But Roger,
How do you see this affecting Australia, Nabila?
Well, this is the thing, because the Aussie banks have been saying, oh, you know, we're not really that exposed and our funding costs are fine and we're fine for now. But there's got to be a time when that contagion spreads to here, and you know it is going to have an effect on the funding markets. And I think you know we can't just sit there and say, oh, it doesn't affect us. Let's just put our heads in the sand. And you've already seen the effect on equity markets.
Yeah, I just wonder though, Roger. You know, do you see the euro surviving or not? Because to say, see, that's the thing. And if the euro goes down,
not in you can't be half pregnant.
No.
You know, you either have fiscal union. Or you don't have anything.
What about the European Central Bank? Because one thing the US Federal Reserve and indeed our own Reserve Bank can do is, of course, print money. The European Central Bank, I believe, is banned by its charter, but maybe they should just bite the bullet there and try and inflate their way out of trouble.
Well, I think what ends up... Look, the scenario that I envisage is if a country defaulted, that country would go into recession. But that is a darn sight better than the depression that they've got now. And it's sustained for much longer. Japan's been through it. And arguably Japan's problem is going to only get worse now with their ageing population. And I think the United States and Europe are staring down the same barrel. So
looking at the Australian issue, I mean, one of the things that the question is to what would Australia do this time now that we actually are in deficit. The government's in deficit, doesn't have the firepower perhaps that it used to have. Interest rates are a lot lower. So the question is, what would be Australia's response if the worst happened? Here's Treasury Secretary Martin Parkinson on this subject.
Almost certainly we would not deal with the next one in the same way we did with the last one. Were there to be a shock now, the first thing to do would be to rely on monetary policy, and indeed we've reduced interest rates significantly since late last year.
Now actually the markets are already anticipating this to some extent. I did an interview with Stephen Koukoulas from Market Economics on this subject, and here it is.